Hello and welcome to Pro Trader Strategies market commentary for Thursday, May the 23rd. I'm Eric Wilkinson with Pro Trader Strategies. Like I said, I'm here to teach you some different strategies you can then implement into your portfolios, but please do that in your own way. Also remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, having that out of the way, let's get it on with some economic data across the pond. I talked about this yesterday. We got some of the most important economic data coming out from the European region in the form of flash manufacturing PMI, which is Purchasing Managers Index. Purchasing Managers Index is these guys at the manufacturing level that buy the raw materials that come into the overall production process, right? So I got a little bit of a chart here for you that you can kind of mull over for just a second. But what we're looking at here is a factory, and this is our purchasing manager. That purchasing manager is buying the raw materials that go into the manufacturing process, right? So he's buying all of these materials over here to go into the manufacturing process because he sees demand. Well, when he starts seeing demand increase, let's say he saw the demand start to increase, all of these people are out here wanting to buy his products, and they're waiting in line. Everybody is out here, and he's like thinking he needs to ramp up production, right? So that's when we see production levels going above 50. We start the PMI numbers are above 50, right? So that's expansion because he continues to see more and more people showing up and wanting his product. So he's got to start increasing these levels over here, right? So he's got what he sees more and more people showing up. Well, with this PMI number, what we're seeing is we're starting to see, well, like I mentioned, anything greater than 50 on this reading is expansion in the economy. Anything that is less than 50 is contraction in the economy, right? So when it's over 50, he starts increasing his buying. That increase in buying, think about it, helps the lumber guys, helps the metal guys, helps the plastic guys, right? That creates velocity of money, and then those guys start producing, and those guys start making more money and start spending it in other places. That creates that velocity of money. But when we start seeing this over here below 50, that means this guy immediately starts going, see, if this guy sees this start to happen and all of a sudden the people are stopping, no longer coming to his place, he is literally going to freak out and start canceling orders for those products. I don't need them anymore. I don't want them because I don't have anybody at my door to buy that, right? So then that level goes below 50, which is really important because we're looking at some PMI numbers coming out of the European region that are going into negative territory. First, let's start off with the French flash services PMI, Purchasing Managers Index, 51.7, expected to be 50.7, so better than expected on that front. French flash manufacturing, remember, France and Germany are the two main manufacturing sectors of the European region. Flash manufacturing for French came in at 50.6, expected to be 50.1, so slightly better than expected there. Last month's number was 49.6, which was a reading below 50. They revised that to 50 exactly, which means there was no expansion, no contraction in the economy. Like I said, it was expected. Last month came in at 49 point something. They revised it to 50. That if it would have come in below 50 this month and they didn't revise last month, then it would have made those numbers look like it was recessionary for the service sector. But we're more concerned about the manufacturing, and that manufacturing for French at least came above the number. But for Germany, it came in at 44.3, pretty friggin' dismal. It was expected to be 44.9 last month, 44 also, and this marks the fifth month in a row that we're seeing German flash manufacturing come in below 50. Not good. Signaling recession. We got the service sector coming in above 50 though. And then for the rest of the European region, flash manufacturing PMI 47.7, expected to be 48.2. Keep in mind that is again the fourth consecutive economic data point for the flash manufacturing PMI in the European region to come in below 50. Service sector, though, PMI for the European region came in at 52.5, slightly lower than the 53, but still showing expansion. Move over here to the United States. We got our flash PMI, but it isn't one of the most important ones. We look at our ISM, but just to note it came in at 50.6, which is expansion in the economy. And natural gas storages, sorry, let me see if I can find the natural gas storages, came out as well. We remember yesterday that oil number being pretty dismal. The natural gas storages came in at 100 billion cubic feet, expected to be 104 billion cubic feet. New home sales here in the United States came in at 673,000 units, expected to be 678,000 units. They did revise last month's number up from 692 to 723, so a nice 30,000 revision to the upside, making up for that 5,000 miss on the headline number this time, but still not going. That headline number may trump everything else, especially with the PMI data that was coming out. So PMI not looking too good, showing a bit of a recessionary type of trend. One thing to note with that, crude oil coming off quite dramatically today with that build yesterday. We saw a sell-off. We're seeing some bad economic data come out across the pond. That's going to show more weakness for the demand of oil. One thing we noted yesterday when I was talking about this, we couldn't sustain above $63 a barrel here. So once we broke below that $63 barrel mark here, I told you the 200-day moving average was probably a sure thing yesterday. We blew right through that today and blew through the 60. I said, 60 could act as a psychological support. That those two numbers not working, right? Boom. Even the 58, if we were looking at this, 59.60 area, that 59 area, boom. That blew through that, not even acting as a support there. Right down to the $58, which is where I thought was going to be a target. We're going to have to look to see if this market really starts melting down here. I talked about we want it in the mid to lower 50s for the economy. That's going to help us out as an economy. When we're spending more money elsewhere, creates velocity. That's what I want to see. I would love to see crude oil be in the 20s for crying out loud, but I don't know if we'll see that. But I would like to see it continue to fall out of bed. Gold futures rallying pretty hard today, blowing through that 1280 Fibonacci's resistance area. It looks like we're going right back to 1300, you guys. This is the 1300 mark right here. That looks like that's going to be where the next stop is. Where we're going to see some support and resistance maybe, or just actually because it's a point of control, it's just going to really settle down there. And then we move over to, I don't want to flip on that. We want to move over to our bond futures. Bonds just blasting off with the overall markets really sloughing off. We're seeing the economic data showing slowdown, recessionary. That should indicate lower interest rates when we see lower, or when we're seeing the economy slow like this. So the bonds, we've talked about this several times with the bonds inverting with the 10-year, which means, as we talked about this, as price goes up, that means, which we're seeing here, price is going up, that means the interest rate is going down, right? So those are the levers and pulleys of the teeter-totter that we talk about, when we're talking about interest rates. Well, once we saw the 10-year, interest rate was lower than the long-term interest rates. The bonds interest rates were even lower than the 10-year. Okay, so that was the invert where bonds started signaling lower interest rates. Now we're seeing the 30-day Fed fund futures. The interest rate here, the rate here is higher than the 10-year now. So the 10-year rate is lower than the is less than the 30 or 30-day Fed funds. So that's really showing that the market is starting to slow. It means that the market is signaling to the Fed that the interest rates are too high in the Fed funds and that they may need to lower those. And this is what we're seeing here. So the big interest rate, if you can look at this right now, we're looking at Fed fund futures. It's trading 97.63. Pretty easy to figure out the rate, which is 237. Let's call it 236 and a half. So 236. The bonds or the 10-year was even below that interest rate. So that is what I wanted to show you there for the inverted yield curve with the bonds to all the way down to the 30-day Fed funds. So it's cruised all the way down there. Now we've got the VIX moving higher because, like we said, the equities are falling out of bed. Dow Jones Industrial Average off about 400 points, but came right back down to the point of control, the POC, which is the magnet. I've talked about this yesterday and the last couple of days. If we can't sustain that move, I think we're going to start rolling back over to the POC. And part of that was because we weren't really seeing it in the E-mini S&Ps. We had already seen it in the NASDAQ that it had come down and tested those levels. I said, though, that with the NASDAQ, it's probably going to have to come back down to this area here, which lines up with 72.30. So we got a little ways to go. That's our next support. I think that is going to be a major support. It's going to take a lot to get through that. The market may come down here, peel to the 200-day, but for the most part, I think it's going to be a bit of a back and forth where we're going to get some big swings, but mostly it's going to want to hang out around this point of control. If we break this level right here, though, we could easily see this go down and test the extremes in the NASDAQ. I don't know if we're really going to see that just yet. I think most of this is going to kind of be working out of some of the inventory and holding out at around the point of control. Again, E-mini S&Ps broke below that 2833 level right here, which is what I've been speaking of as acting as support, but breaking below that, we're going to easily see this market come back down, maybe stall out at 2,800. That should act as a psychological level as well as the point of control. So people will say, hey, it's a psychological level, but it lines up with the point of control, and that's where the market's going to want to settle down. But as we know, the markets like to press the thumb screws on us as often as they can. So I could see this market wanting to trade down below that 2,800 and test the 2,700. So, sorry, bad habit, dropping the first digit. But 2,700, I think, is somewhere where we're going to be looking to go to in the E-mini S&Ps, especially if we get any more dismal data. This was the sure sign that the market was really not going to come back today. I talk about this anytime there's just absolutely no intent to flush out the overnight inventory, which was very short. Based on the economic data that we were getting overnight, which comes in and right around in this area is where the overnight PMI numbers were coming out overseas. And you can see that that was just the catalyst for the bearishness in the markets today across the board for the part. So I would not be surprised to see this market continue to slump. All right, Tesla. I talked about this yesterday. I tweeted this out and had a pretty funny GIF, actually, that I was putting out that I got out of this trade finally. So you can check that out. Follow me on Twitter if you want to follow that misery. But anyway, I said I was going to be out at 194.50. We traded down there yesterday and settled below that Fibonacci. That's when I decided to get out of it, when it was starting to look pretty bad. So interesting enough, though, you can see volatility is really starting to expand in there, despite the fact that there's nothing going on other than this sell-off in Tesla and a lot of bad news. So the market really started coming off. Well, when the market started breaking below 195, I put in the order to get out of this. And if you guys remember, I have on the July, I'll just write it down. It's the July. I bought the 165 calls, sold the 235 calls in there for $39.22. Well, on those July, buying those July 165 calls and selling the July 235 calls, I did that spread for $39.22. Like I said, I dumped out of that trade. I'm out at $32.50. All right, but when this market broke below 140, what was it, 194.50, we started breaking below that. That's when I put this trade on at 32.51. I wasn't able to get it. The market continued to sell off. I could probably flip this over to the daily chart. Let's go to a daily chart and break it down a little bit. But you can see as the day started going on, towards the end of the day, we started getting, that's today's section. So throughout the day, we saw continued expansion in volatility. As a matter of fact, it went from a 0.67 all the way up to the end of the day at a 0.77. So a 10% increase in volatility totally negated some of that downside move that I was experiencing. Like I said, I saw this market start to break down. I put in that order. The market never came back and continued to slide. But because I set this up according to my rules, it had low implied volatility. I expected maybe volatility to stay remaining the same, but I put myself in a low implied volatility environment, and if volatility would expand, it helped me. Well, this type of move where we saw the market coming off like that and this 10% volatility increase, I talk about this in the webinars, how it can counteract the negative move. I can be directionally wrong and still be right. Well, I was still wrong on this because I'd ridden the market down a little bit. But what I'm saying here is, as soon as I decided to put that trade on, or take it off, I should say, and the market continued to come off and volatility really expanded for me, it allowed me to get out at a price that I didn't actually expect to get out. I was about, when I put this trade in, it immediately started moving against me. I was about $1 something away, about $1.50 away. And with that expansion in volatility, 10% increase on that, I was able to get out for a profit, and it countered the negative market move for me. So that was pretty fun ride. I mean, not to say that losing on a trade is fun anytime. I would never say that, really. But it was very reassuring to see that when my directional assumption was wrong and that volatility expanding for me actually allowed me to get out of a trade that I shouldn't have been able to get out of. That's what made that a little bit more exciting. So follow those rules. I'm telling you guys, even though you're directionally wrong, it can still help you out. And I talk about how to set these strategies up in all of the webinars. So if you are watching those webinars, make sure you follow those rules, because it helps you stay mechanical and can help you increase your probabilities of success. In that, I had a bullish trade on, but because I set it up according to my rules, I allowed myself an opportunity to get out at a much better price than I would normally have. All right, that's all I got for you guys. Check out those webinars. Also, I'm going to be doing one today on a bullish assumption when we have high implied volatility. As a matter of fact, the way Tesla's coming out, I usually don't look back at trades. This one I dumped out. The market's starting to pop. Why? Because Elon Musk has learned that he shouldn't tweet it out himself. He's just got to release an internal memo and let everybody else do the leaking of the information. And he said that basically they are going to be able to meet production of several hundred Model 3s per month. So that has caused this market to settle down and start to rebound. So it might be a good opportunity for some premium selling strategies, because we got that extremely high implied volatility. Like I said, I got into this strategy as a long call spread because volatility was relatively low. Now that it's expanded so fast, it's time to take advantage of premium selling strategies, because as we've talked about, when volatility expands quickly, it comes out quickly. And I'll show you how to take advantage of that in today's webinar. So check it out at Pro Trader Strategies or at wolfmansoptions.com. All right? If you can't take that, take it easy.